Good afternoon, everyone. My name is Keith Whalen from RPI Consultants. I want to thank you once again for attending this afternoon's webinar on P-card management best practices. We have two great presenters for you today. Justin Braun, one of the partners at RPI, also head of service delivery. Chris Gordon, who you have seen from other webinars, one of our top financials consultants. My understanding is that the theme today in honor of Halloween is Dia de los Muertos, and Justin's going to do this presentation in Spanish, and Gordon is going to translate it to English. So it's going to be a lot of fun. Hope you're ready. Two quick housekeeping notes. Please do ask questions as they come along. We'll try to take them as the presentation goes. It helps with the conversational flow. Know that we will be recording this webinar and posting on YouTube. And if we want to keep track of our recordings and future webinars, please go to our site, www.rpic.com/webinars, or join our group in Digital Concourse. And without further ado, I give you Mr. Justin Braun, Mr. Chris Gordon.
Thanks, Keith. Thanks a lot, Keith. We're going to go with a Dia de los Workflows format today, so if you're following along and you're watching on YouTube, please be sure to grab a copy of the slide deck and follow along. Some of the screens that you'll see in the YouTube video don't come through quite as clearly as our live audience today. We're going to talk about P-card best practices, but before we do that, let's talk a little bit about RPI. For those that don't know, we're a Baltimore-based Infor partner covering all product suites, founded in Baltimore in 1999. I've been with the firm since 2008 and Chris, 2012. So at this point in our evolution, we have over 60 consultants across the country covering all the normal areas of Infor, technical, all the functional domains. We really pride ourselves on our ability to work as a team. We provide continuity around certain solution offerings, and Chris and I have had the pleasure to work together on quite a few P-card implementations. In addition to Infor Lawson, we enjoy group pictures in exotic locations. So on the screen now, you've got us at Inform this past July. Had a really good team there. You can probably see Chris and I with the Dia de los Muertos theme, and we were having so much fun. This is a picture of a smaller group in our office. So today's agenda, we're going to talk, when you talk about P-card best practices, for the context of this webinar, we're going to talk about, as those pertain to Lawson, Infor Lawson, how you can leverage the purpose-built solution with Infor Lawson in the context of a P-card. And what I've found in my experience on this is that when you talk about P-cards, you're typically talking about one of three very different applications of a P-card in the procure-to-pay process. So we're going to talk about those things first. We're going to talk about sort of the characteristics and considerations of what I call a P-card as mode of purchase program. And then we're going to talk about that mode of purchase from a centralized and a decentralized model. And it'll be clear when I get to the workflow what I'm talking about. The other thing we hear a lot about and we deal with and we work with a lot of the P-card provider banks is P-card as a mode of payment. So to try and put those three very different P-card applications in context and help you understand, we believe will help you, better manage your P-card projects. And maybe you're doing some of P-card as mode of purchase today and you want to make it a little bit better. And maybe today you learn a little bit about P-card as mode of payment, and that becomes something that you want to learn more about, and you can talk with your bank representative about that. So that's basically the plan. And let's get into the P-card in the P2P process. So it starts really with this decision tree, and I'm going to kind of walk you through it in a narrative. It all starts like any procure-to-pay function. It all starts with the need for a product or service is identified. It's the first box. The next box is consult your procure-to-pay decision matrix. You might call that a procure-to-pay policy that essentially stipulates how any user within your organization buys the things that drive your business. So if you're a healthcare organization, a user in the OR that needs a med-surg supply has a much different procurement process than an office manager who wants to take his team out for pizza. So in the procurement function, your job is to enable those purchases in a way that balances the ease of use and the customer service with the controls and the optimization of the procurement function. And P-cards are very useful in certain types of transactions. Certain purchases, do not require the overhead of creating a vendor, for example. And P-card as a decentralized P-card as mode of purchase program is very appropriate for that. So when you look into your decision, your P2P decision matrix, which is part of the best practice, it's something that we recommend every client has to sort of manage those expectations of your customers out there looking to purchase things. There's a subset of your purchases that are appropriate for P-cards, and those could be things like traveling to a conference, buying that pizza for your team to have a team lunch, maybe some online ordering, the types of supplies that are not normally associated with vendors in your Lawson vendor file. So that's really the first break is, that first blue diamond, is this purchase appropriate for a P-card? And if the answer to that is yes, then you're talking about a decentralized P-card as mode of purchase program. If it's not appropriate for a P-card, if someone wants to buy something that you don't want a card holder to be able to go and make that purchase independently, then you're, normally what we see, the best practice is to have, an online requisitioning system like Invoicing's Requisition Center to enable your users to submit their requests electronically through a requisition portal, which would, it's implied that there's a requisition approval process that's occurring, and through that process, that requisition is going to ultimately route into purchasing after it's hopefully been approved, electronically. So in purchasing, you might have, a normal thing like that med-surg supply that somebody wants, and it's appropriate for a vendor purchase order. We're going to get that supply from Owens & Minor. We know it's contracted. Maybe you're even using the PO25 module and contract management to drive that purchase to your GPO contract negotiated price. Tons of requisitions follow that path of submission, approval, conversion into a normal Lawson purchase order that then follows the normal, receiving and delivery and put away cycle. The invoice comes in, you achieve that three-way match, and I'm kind of moving along that second tier here. And that's where P-card as mode of payment comes in. So the P-card as mode of payment, everything in your process remains exactly as it is today from the perspective of requisitioning all the way through to the payment. What changes is now the payment mechanism, rather than being, say, a check that you use bottom line or MHC to produce a check to pay your vendor. Now you've got this new program where all of that spend is going through a P-card, and that's a P-card as mode of payment. And different banks offer different flavors of that same type of program. And we've worked, I think, with them all at this point. We've worked with PNC, Wells Fargo, Bank of America, JP Morgan Chase, American Express. So they all do it essentially the same way, where now you've essentially enrolled one of your suppliers in their network, and they've agreed to accept payment from your organization on either a dedicated credit card for them or more commonly like a virtual pool of single-use account credit cards. And that's what a P-card as a mode of payment is. Very different drivers than a P-card as mode of purchase, right? In the context of P-card for mode of purchase, you're trying to achieve ease of use for your users. You're trying to gain efficiency in your process, and you're using that for a very small subset of your spend that is appropriate for that type of mechanism where you essentially trust your cardholders to make those transactions. The P-card as mode of payment leverages all the controls of your normal procure-to-pay process, from the rec approval to the invoice three-way match. But you're still getting that payment on a P-card, which the main benefit of that program is the rebate. Normally when you transact on a P-card with a merchant, they're essentially accepting, say 97 or 98 cents on the dollar in exchange for the promptness that they get and the ease of use that they get as a P-card merchant. And what the banks do is they take that margin, they share it with you in the form of a rebate. And all P-card programs come with some level of rebate, whether it's mode of purchase or mode of payment. That's the main driver that we see for P-card as mode of payment, is the ability, particularly if you're a large organization that has a high volume of spend with many vendors that already have that P-card percentage kind of built into their costing and their course of business. It's a very easy way, especially the higher the spend, the higher the rebate. It's a very straightforward way to get some revenue back into the AP department. You have to be a little bit careful with how far you go with that, because some vendors Some suppliers will get wise on that and actually increase your prices. So I would not consider it best practice to pay, say, Owens & Minor on a P-card program, although some do it. So that's pretty nuanced. But again, that's P-card as mode of payment, very different than P-card as mode of purchase. The last point that we've also, and we've implemented each of these at our clients. One of our clients had kind of a hybrid need where it was, they didn't, frankly, and we hear this a lot in P-card as mode of purchase. We don't want our card holders out there with credit cards and no ability to proactively control how they use them. And that's a very valid point, especially for the folks in finance and the controllers of the world. The job title, controller. The way to kind of work around that and still gain some of the efficiencies of P-card as mode of purchase is to centralize where that credit card is used. And the example I like to use for this is like web ordering. Say you're trying to buy books for people in your organization, but you don't want that. You don't want to have that department head or all those department heads have credit cards for buying those books, or even the education department. You still want to maintain that control in purchasing. So again, you meander through your process of you identified a need for a product. You consult your P2P decision matrix or your procure to pay policy. It's not appropriate for a P-card holder to go and buy it on their own with their P-card. So they submit the online requisition. And maybe if it's going through Amazon, there's a certain PO code. There's certain attributes you can build into that rec approval to flag that as not a normal vendor purchase order like the Owens & Minor and healthcare example that I used. This would be something that's not a normal vendor PO, but still something that purchasing can buy on the behalf of that requester on a P card, and then there's kind of a mechanism then to achieve that match using Lawson's built-in PD module functionality. So that's kind of a hybrid approach where it's predicated on the existence of an online requisition system and that approval process to achieve it, and then some trained users in purchasing to convert those requisitions into purchase orders that they transact in purchasing on a P card. And online web ordering is becoming more and more prevalent, and that's a good example where you can do that and follow that through. And we'll get into some of the nuances of that. So. Again, this is just kind of a walkthrough on that. And the characteristics and benefits of a decentralized P-card as mode of purchase program is that the vendor and the PO and the invoice are not required. And that's, there are certain types of purchases, routine spend, office supplies in many cases. There's definitely a subset of your spend that's appropriate, and check request is a good one. We see a lot of AP departments that are burdened with check request volume that a well-administered P-card as mode of purchase program can alleviate. So it really frees up transaction volume in AP if you're able to put this type of program into place for certain types of spend. Now, the thing about credit cards is, it's you give them to your kids and you go to the mall, you don't necessarily know what they're going to get, right? And the same is true if you're deploying P cards throughout your organization. So you absolutely have to have some controls. So having those controls includes, documenting and communicating, well-established P cards usage guidelines, and holding your users accountable to those. And you can't hold them accountable if you're not watching. So the role of a P-card administrator becomes very important. The P-card administrator would conduct routine audits on your organization's P-card activity. Some full statement, random based of I want to review the entire statement of this P-card holder. We recommend you let your folks know that you're doing that because one of the big fears of this type of P-card program is fraud within the organization, and we found that people are much more likely to follow the rules if they know they're being watched. So having a P-card administrator that's doing those types of audits, sometimes asking questions, it's for the betterment of the organization to do so. And also, looking for maybe pattern-based audits. So you can filter activity by certain merchant category codes. So if you're giving someone a P-card for buying gas in the company truck and they're using merchant category codes for travel or hotels, then that's a pretty easy pattern to pick up. And there's even tools that'll automate that kind of continuous monitoring of P-card activity if you want to get that sophisticated. But just the point is to have a process and a person ultimately responsible to monitor and administer that program is one of the key controls, and it's a characteristic of this program. You can also leverage your bank to administer some controls. So I mentioned those merchant category codes. Everyone that accepts a credit card has a merchant category code, and you can basically tell your P-card provider that, hey, this card, we only want to work with this small subset of merchant category codes. So that example I gave with the company truck, you could, through your bank, configure that card so that it wouldn't work with an airline merchant category code or a hotel merchant category code. You can also cap transaction limits on a P-card. So there's things you can do through your bank provider to proactively, at the point of sale, control cardholder activity. And that's whenever that's possible, it's always a good idea to prevent something rather than having to clean it up after the fact. Characteristically, right, these detailed transactions are occurring outside of Lawson. And in some respects, that's the point, but you still want to have that rich detail. And that's where the Lawson PD module comes in. So I think it was in Lawson version 9.0. It came, the PD screens were now bundled in the PO module, and you can use that module to import transaction detail for your P-card statement. And I'm going to get into some flows that show exactly how that works. You bring that monthly statement into Lawson, or you can bring them daily into Lawson. Normally we see this type of integration from your bank to Lawson. You know, when we come in and we start working with somebody, they probably have a journal entry process that's happening every month, and it's somebody's job to build that spreadsheet for that journal entry. Very cumbersome, very manual, monthly process that you can very quickly eliminate with, you know, a couple mapping and integration conversations with your bank and this PD module. And what that's going to do is it's going to suck in all those charge transactions that are in the bank system into the Lawson system of record. And it creates an invoice off of that statement payable to bank. So, you know, best practice is to do so within Lawson monthly. The utility of bringing charges into Lawson daily is, you know, it really, we have not seen that. Another consideration is where you code those charges. So I consider it best practice to automate that as much as possible. So you can make determinations maybe about your company accounting unit based on who the cardholder is, what their home cost center is, as an example. You can drive the account or sub-account of a transaction based off of the merchant category code. Because normally if you look at the list of merchant category codes, that'll map pretty well to your chart of accounts, or the natural class as it's sometimes called. So you can build that integration. As you move the transactions from the bank into Lawson, you can build that logic to essentially pre-code all of your transactions. And then you give your cardholders the opportunity to override those defaults. They can either do so, most of the bank providers will have that mechanism within their website. And that's, in many respects, a lot easier. Or if you want to bring those transactions into Lawson, you can use the PD 20 screen to code them in Lawson. And, you know, if you do code in the bank system, obviously having a feed of your GL information into the bank system, because your GL information may change over time, having some mechanism to upload that to their site is a good, you know, is a best practice, and that's something that we've worked a lot with as well. So those are characteristics of a decentralized P-card as mode of purchase policy. That is James Dean. And all the pictures from here on out are members of the 27 Club, by the way, for those that are following along. So the characteristics, now we're going to talk again, P-card is mode of purchase, centralized, right? And you know how the flow goes, because I already talked about it, but you know, it's not the type of PO that you would normally have on a vendor, but you want to transact on a maybe a credit card that's maintained in purchasing that's specifically used for these types of purchases. And the characteristics of this program, it allows purchasing to accommodate their customers in a streamlined fashion. So there's, you know, again, it's within your P2P policy. It's not for every purchase by any stretch, but if you have some, you know, subset of recurring purchases that it makes sense for, it allows you to do those things without having to create without having to work with AP to create the vendor record. You're still getting all the detail and all the controls on the rec approval that you need to process that transaction. So you're streamlining and purchasing. You're converting recs into POs for, again, a certain subset of your requisitions. So there's a training element there and kind of a consensus and buy-in on exactly what types of purchases do we want to use this card for. We do recommend having a dedicated card used for these purchases, and that card is not used for ad hoc purchases. And I'm going to talk about the difference within the semantics of Lawson's PD module, the difference between an ad hoc charge and a PO charge is very important. And having a dedicated card that you only use to buy things that are on a Lawson PO is really going to help that integration stream and all the reconciliation that happens thereafter. So that's definitely a best practice, and all of our clients that have done this follow that practice.
So one card for the entire department.
One card that's used for this function, right?
Yeah.
I mean, you could have 5 proxies out there that follow the same process depending on the size of the organization, but the key is that card is not used for ad hoc charges. The ad hoc charge is the classic, like, I don't want a vendor, I don't need to do a requisition, it's okay for me to go to Home Depot and buy some material repairs because I work in maintenance and that's what they gave me the card to do. Like, that's fine.
And is there a way in Lawson to control vendors that are allowed to be used with that card, or is that strictly at the bank level?
Not in this context. There's a way in Lawson to associate a vendor with a particular card for PO charges, but this centralized P card process is it's almost more of a hack of some of the existing functionality.
Yeah.
So really, the control in that context would be either it would be on purchasing. That would be where the control would be maintained. Now, you can't build a PO in Lawson without a vendor, and here we are talking about an application of P cards that alleviate the need for a vendor. So how do you bridge that? You build a ghost vendor. So, and again, you can have one or several ghost vendors that drive how you build that purchase order. And all that purchase order is really doing for you at that point is it's giving you a mechanism to hold the coding that was associated with that approved requisition. So you are gaining an audit trail through this process. And that's kind of how it works. A lot of it hinges on the presence of online requisitioning and that approval process, because that's the value. Is in this model you're getting documented approval before the charge occurs on a credit card, and then you're getting a purchase order to hold the coding associated with that transaction, so that when those goods arrive and they're received, and we use an evaluated receipt settlement to create that invoice and facilitate the match. Yeah, nobody has to code that transaction. It was already coded during the rec approval and PO process.
That's why it's really important to have a good rec flow, approval flow up front.
Yeah, I mean, this program wouldn't really have a lot of benefit if you didn't already have an online rec system, ideally with approvals, because that's really how this application came to be. Was we had a lot of clients that wanted to use P cards, but they didn't want to have P cards deployed throughout their entire organization. So that's where we're able to leverage some of our RQC and workflow best practices and build in the P cards, so you still get that streamlined experience of not having to cross the aisle and go to AP and get the forms to set up a vendor for a purchase that you might not necessarily have to make with that vendor ever again. I did sort of mention that this process does require an invoice, and there's a few ways that you can handle that. The one that we're going to dive into a little deeper has to do with evaluated receipt settlement. So there's a program in Lawson, MA530, which will turn a released receiver record into an invoice, and it's a really great way to get an invoice that matches perfectly to your receipt. And it's appropriate here, because how else are you in this model? If you're buying something from Amazon, your only hope of getting an invoice from Amazon is either statement billing off their website or using the packing list as an invoice, and that's kind of what evaluated receipt settlement allows you to do. So that kind of works out well in this stream. And you still can bring these charges into the Lawson PD module, so that you have all of that detail, and there's some cash flow savings associated with that if you do that. as well, but it is in memo only. So to help you understand what I mean by that, these next couple slides show the difference from how Lawson handles, when you're integrating into your Lawson PD module, your bank transactions, it's going to show you the difference between an ad hoc and a PO charge. It's literally, there's a field in the PD 570 CSV file called PO number. And if that field is populated with anything, then Lawson's going to treat that as a PO charge. And it treats those charges very differently than a record that doesn't have a PO number associated with it. And that's actually, going back, one of the reasons I recommend having a dedicated card for POs that's not picking up ad hoc charges, is because it's going to help you reconcile that statement to know that, hey, this card I only use for POs, and therefore I should see an invoice in the system for every one of these charges. But to kind of walk you through the workflow, the bank's the big square in the middle there, and your card holders are transacting through merchants, and the bank is collecting charges throughout the month. Your statement close hits just like a normal credit card, and you get a statement of here's all of your charges throughout the month. And what you do is you take that data and you map it to PD 570 format, and that's just like a common Lawson 500 series interface job that'll, it can run off of a flat file in CSV or staging tables, like the PA 57 or PD 57 screen. That's going to import that statement, and there's a job that follows that. PD 130 basically converts that statement with all of the charge detail into an invoice, and at that point that invoice it goes through a normal payment process just like any other invoice, and it's payable back to the bank. So that's kind of how that process works. And it's at the PD 570 that you get the opportunity in PD 20 to either approve or close or both all of those charges using the PD module. I can't say it's a best practice, but I can say all of our clients that integrate using the PD module do use the closed feature. So they do all of their coding in the bank system. They have mechanisms to make sure that that's all clean and accurate coding before it's brought in. And they import that charge detail into Lawson in a closed status. They're not using the PD 20 screens for approval. Although, you definitely could. The PD 130 is what creates that invoice. So it ends up being payable to the bank. And sometimes there is misconception on reporting in this one in particular, because if you happen to have somebody that you're doing business with, a vendor that is in your vendor file, as well as buying from that same vendor on a P card using this model, it's very difficult to get consolidated spend for that vendor, because it's not impossible, but it's not intuitive. All the standard Lawson AP reports that show vendor history, they see all the charges on your statement associated with the bank or associated with the vendor that's your bank. So your vendor is Bank of America. This process creates an invoice payable to Bank of America. There are some tables where you can maintain a relationship between merchants and vendors, and if that table's up to date, you can leverage that to get that information, but it's not out of the box the way that you would probably like it to be. So if you are particularly in the public sector and you have reporting requirements around certain vendors that you spend more than X dollars per month, then that's a consideration for you to look at, because you would have to have, just like you have today, you would have to have some kind of mechanism to get that consolidated spend. So that's the ad hoc charges, and that's kind of the workflow for how that works. Again, it creates an invoice. The PO charges, they come in the same way. They just have that PO field populated, and as a result, PD 130 will not see them. So they're not part of the invoice. Lawson assumes, in its wisdom, that since you've gone to the trouble of creating a PO, that you want to have an invoice match against that PO. So that's what's really key, is you need to make sure you have a mechanism to get invoices on any charges that you are transacting in a P card that are associated with POs. because if you don't have that invoice, then it's just going to sit out there forever. You'll still get those charges imported, and they're in that memo-only status. So there's nothing you can change about them. You can't use PD20 to recode them if you wanted to. It's coding from the purchase order. And that picture is kind of worth 1,000 words to help explain that difference. The PO charges generally are pretty rare, and really the only place that we recommend using them is in that context where you have some central control over that process. Maybe if you have certain vendors that you want to have cards and work just with them on a dedicated card, or that that centralized process, some type of centralization in your P card as mode of purchase policy is what makes POs a little bit more achievable when you think about how that process works. But beyond that, really, P card as mode of purchase is really about the benefits of a decentralized, ease of use for certain folks within your organization that you trust to be held accountable to well-defined guidelines.
And the MA job that creates the invoice and matches, that it's the MA 530. That falls in between the PO 30 and AP 20 up there, right? In terms of the receipt comes in, MA 530 runs.
Yep. Yeah, normally that's just run. That could run every night, and you could run the MA 540 right after it to match them. Yep. All right. So that's thus concludes. This isn't always the easiest topic to talk about. Best practices and cloud migrations is much easier. But the last one is, again, those, trying to direct more spend towards this program, but not wanting to lose the controls is really where the E-payables or P card as mode of payment programs come in. As you can see, that PO-driven process that we just talked through, it's not the most intuitive process. It would need to be something that you'd really take a look at and test through and communicate about. If you roll out P card as mode of payment, which the banks are chomping at the bit to help you to do, by the way, if you're able to do that, it makes the process there's so much less change management, because nothing is changing except a payment vehicle. You're not having to change anybody's end user behavior. You've already got a good online rec approval process in place, and you're basically just leveraging that all the way through. So your existing rec to check process and all the controls contained therein, they remain intact. Vendors that want to participate in this payment mechanism need to enroll in it. So there's an enrollment campaign that's going to be driven by your P card provider. And again, we've worked with them all. JP Morgan does a really good job. They work with you to kind of create the language that they use to approach your vendors. They'll start with a copy of your vendor file and bounce that against their members and let you know, hey, based on your spend, if you were in our program, you could have gotten X amount of rebate last year. So they'll do that analysis for you, and they'll use the information in your vendor file to contact your vendors on your behalf and try to get them to enroll in this campaign. The only change really in Lawson is setting up a couple special payment codes or payment formats to get the credit side of that payment transaction to book to a slightly different account, and to kind of quarantine these payment transactions from other normal payment transactions. So there's definitely some work, and it becomes an interface project where you're mapping Lawson's payment output, normally the AP 161. You're mapping that to the file or the information that the bank needs to bring in to create these payments through their mechanism, and communicate your remittance detail on those payments. So there's some integration work there, but the good news is the banks they're very helpful in getting you through that enrollment campaign. You're not going to be calling vendors and asking them to switch. That'll all be done for you. And it really, the AP configurations drive the cash payment code on the vendor. So when you talk about enrolling that vendor in Lawson, it's literally as simple as switching either the cash code or the payment format or both from one to the next. And once you set that at the vendor level, it'll cascade down to all their invoices, and all their invoices will schedule for payment. It's not all or nothing. Sometimes you might have a vendor that still wants a physical check, maybe for a deposit on a type of purchase, you can always override any transaction with what the default is. But that's really all that's required in Lawson, is setting up a couple special cash codes, having that mapping conversation with the bank, and then you're good to go. The AP 161, it gives you the most detail for it. Another nice bonus, a lot of these banks, including definitely Bank of America, JP Morgan, they'll often take that same input file and they'll do ACH just as well as these e-payments. So if you have certain vendors that you want to pay via ACH, this is another mechanism that you can do that. At the end of the day, when you're in an e-payables program in Lawson still very much thinks of these payments as checks, and that's an important thing to understand. So when you partner with these banks, there's an exact authorization feature that I consider best practice. If you don't turn that on, it gets kind of weird. Lawson has, like, say, a $100 check, but somebody has now cashed that check for $50. Like, that wouldn't work in a physical check world, but it actually, in a P-card world, if you don't have exact authorization on, you can end up in that situation and you get these weird recon records. So turning on exact authorization will help with that. It'll basically eliminate that. And just knowing that Lawson still thinks of these payments as checks is important too, because you know, just like a check, you probably have a process to bring back like a CB 185, or maybe somebody's just updating your cash payment CB80 screen manually, you know, voiding checks or turning an open check to a reconciled check. That's part of the process too, and it actually helps you reconcile the activity on those cards. The benefit of the e-payables program, as I mentioned before, there's kind of a one-time benefit associated with cash float, so that you know, now that you're going through this P-card program, you can pay your vendors potentially 30 or 45 days before you actually have to pay the cash to the bank. So when you first roll it out, there's an immediate sort of cash float benefit, but it's really more of a one-time benefit. The other obvious benefit is driving more rebate towards the P-cards. That's pretty much it on the P-card as mode of payment, and that's pretty much it on my presentation.
All right, with that, I think we will close our final webinar of our October Halloween series. I want to thank Justin, I want to thank Chris, Bill, Carlos, Greg Marsh from SLM Media, and we hope to see you again in December. Thank you very much. Have a great day.